Hello and welcome to Building the Premier Accounting Firm. I'm your host, Roger Knecht, President of Universal Accounting Center, and this is a podcast dedicated to helping individuals own and operate successful bookkeeping, accounting, and tax businesses. It's here on the show that each and every week we have on experts, individuals to help us actually understand things that we can be better at, such as marketing, selling, pricing, tech stacks, training our staff, mental health, just a variety of the things that we need to consider as we're trying to build the premier accounting firm, offering quality accounting services, and most importantly, getting paid what we're worth. It's here on the show that I'd like to actually dive into those things with our guests, and one today is going to be Eric Gordon. Eric's someone that I was looking forward to speaking with. He brings a diverse background and extensive experience in accounting and commercial real estate because he is the Vice President of Professional Services at B10 Energy. He is actually a Boise State alumni. Eric actually launched his career in accounting after graduating and went to Deloitte as an auditor in the Boise, Idaho office. He eventually transitioned from public accounting into commercial real estate, where he actually honed his skills in pre-acquisition due diligence, asset purchase negotiations, debt sourcing, and equity raising. When he was not shaping the future at B10 Energy, Eric is an avid traveler, a baseball fan, enjoys country music, and values time spent with his wife and 4 daughters. He also pursues a personal interest in real estate investing, blending professional acumen with personal passion. So, Eric, welcome to the show.
Hey, thanks for having me. Excited to be here.
Yeah, your experience here is going to be very, very interesting because I'm excited for a discussion as it relates to your career and what it is that you've experienced as you've worked with accounting professionals now, servicing them and their clients. So first of all, give me an idea of why become an accountant back in the day. Why was that as a profession of interest to you?
You know, it's interesting. I went to school to become a dentist. So that was the plan. And I had talked to a number of dentists about what they lacked. And they said, I wish I had a better understanding of the business side of things, and I'm like, oh, okay. So I took an intro to accounting class of like, this will probably help me, run a successful dental practice. So I took an intro to accounting class. I was probably one of 700 kids in that class, my freshman year in college, in a huge auditorium. And our professor, I'll never forget him, Norm Nemro, he had retired from real estate, and he had retired probably earlier than most from California real estate, came to the school and wanted to teach. And they had told him, you don't have a PhD, you don't have your doctorate, probably it's not going to work out, teaching here. And he's like, well, what if I teach for free? And we're like, well, when can you start? He started teaching for free. And I get into that class, and somehow to 700 students, Norm made accounting seem cool. And it was just like, this is the language of business, and this is what you do, and this is how you use it. And I just sat in there and soaked it up. And I was like, this is so cool. And it just made sense, and it clicked. It's funny, accounting cool. Some people are going to disagree with me on that, right? But it just made sense. And I really liked it. And his background in real estate and what he did. And as I kind of went through, I'm like, hey, I really like this. And so I ended up dropping the whole bid to become a dentist. Majoring in accounting, like I said, and then upon graduation, went to work for Deloitte. Mainly, I thought it was a great firm. I love the people I interviewed with, and they had a lot of real estate and construction clients in the office I worked in, which was of great interest to me. And I thought, hey, I think this can be a career. I think this is what I want to do.
Well, first of all, I love the fact that you were exposed to accounting in the way that you were. Accounting is cool. It is a great profession. And obviously, it is the underlings of what everything is going on business-wise, because it is the language of business. But I'm so happy to know that you actually were exposed to it by someone that was as passionate as they were about accounting, to work even for free teaching it, because I'm not doing this for free myself, but I can definitely tell you that I do love it. And one of the things that's very important to me is giving people that excitement and enthusiasm for accounting, because that is something that I think is very much exciting to do. So that's wonderful. Now, as it relates to your career, you obviously got into the real estate side of things. What are some of the unique things as it relates to accounting when we're looking at real estate?
It's what helped me coming from an audit background. So I started in due diligence. And I think what really helped me was coming from being an auditor, and knowing how to look at things and dive in and find out what's right, what's not right, understanding what a sample size is, understanding what you're looking for, right? And even just that, I think that mindset of, that trust but verify. I'm going to find the source documents for this. I'm going to make sure this is right. You give me a rent roll. Well, I'm going to look at every lease and make sure those numbers are accurate on the rent roll you gave me. I'm going to back it up. I'm going to make sure it's signed. I'm going to send out an estoppel, right, that the tenant agrees to these numbers that I have in this lease, because I want independent verification of it. And so I think that was one of the things that really helped, was just the mindset and understanding, commercial real estate. When you're buying assets, you talk about cap rate, net operating income and your purchase price and this and that, and to be able to know what made up those figures and how to get to them and what it is, and look at growth rates. And so I think for me, that was a huge advantage of having the background in accounting. And just from, I love Deloitte. I think you can get similar experiences at a lot of firms, but the clients that I worked on, and really going into there, and I think that set me apart from other people in the department, in the company, that didn't have that experience and maybe struggled with understanding the numbers aspect of all these purchases. So it was huge for me to start my career.
Well, from an accounting point of view, let's dive into this a little bit then and look at it from two different points. One is the acquisition of commercial real estate. From an accounting point of view, there are a few things that I'm sure you would suggest are essential to know and look at and consider when making a good purchase. What are some of the things that an accounting professional should be helping their clients with as they're considering an investment in commercial real estate? What are some of the numbers they should be asking or questions they should be asking?
I mean, I think it starts with, you have to know how much income that asset's going to produce, right? When you're talking commercial real estate, income producing real estate, right? Of knowing, okay, what will this produce? And then being able to put in factors such as, you're not going to be 100% occupied every day of the year, every year that you own this, right? So what's a good vacancy percentage to put in there, right? And even if it's currently 100% occupied, it's not going to stay that way. Tenants are going to move out. Someone's not going to pay their rent, right? So really getting into that. And so knowing those numbers, and then knowing the expenses associated with that purchase and with that building and the operating of what tenants are going to pay for, what tenants aren't going to pay for. One story that comes to mind is actually from a tenant. And it was a coffee shop in a building that we owned. And they had made the comment one day, and he was struggling, and he's like, do you guys know how many coffees I have to sell just to break even on my rent? And we knew him. Greg was like, I don't know exactly, but you should know that number. And especially before you sign a 7-year lease, going through there. And it was just, I think he got excited about it. And, it's a romantic thing. It's fun. It's exciting. But to really get into the numbers and say, okay, what will this produce? Right? What are going to be my expenses? At the end of the day, am I going to pay a management company? What is that going to cost me to manage the building? Am I going to pay leasing agents, right, a commission to lease the building for me, right? What is that going to cost? And really going through there and having a very tight model, right, of exactly, and using, you're going to make some assumptions, right? We all do, but being conservative in those assumptions, right, of what is my occupancy going to be? What are my future rents going to be? What's going to be the increase? What am I currently getting? What am I contractual to get? And I've seen that mistake as people have bought commercial real estate and they've made assumptions on rent growth. It's going to grow by 5% a year. And it's like, well, you're under contract for 2.5% a year for the next 5 years. So it can't grow, unless you completely get rid of those tenants, which they have a right to be there. They have a lease. And so when you assume a 5% growth on rents every year on every suite in your building, that's impossible. You're contractually obligated to only increase it by such amount. So I think starting with that, right, and really understanding the numbers behind the transaction and getting to the meat and potatoes of what it is, and knowing this is what's going to come in, this is what it's going to cost me, right? And really factoring, most people when they buy real estate put debt on it, and understanding how that debt's going to work, and what are the factors, what that debt's going to cost you. Right, not just interest rate, but your upfront points and anything like that, and the term of that. So I think those, from my standpoint, the fun part about real estate is look at something really cool, like look at that building, it's awesome, and going through this, which it is. I love it. I still like walking into buildings. I still like walking into construction projects and smelling the paint and smelling the wood, but it's got to make money for you, right? And you have to understand what that's going to do long term.
So you've addressed a few things. I'm going to add to it. One of them is the break-even point, which is what you brought up. You've got to know what that is. In addition to the break-even point, it's good to do comps. You can actually, with the comps, determine, okay, if this is the let's say a Class A building, we can know what the comps are for that square footage rate, and we can determine then, okay, what can we anticipate with the rents? But you brought up another good point, which is what can we anticipate the increases to be over time? Well, you can easily figure out what those are just in the contracts that are already signed with the leasing that's going on. So all of a sudden, you've got some good numbers here that you can do for calculations, forecasting, and such. So the next thing from an accounting point of view is, let's assume that the commercial property is purchased. There's probably some renovations that we're going to be doing, some upgrades that are going to be done. We might be looking at cost segregation. What advice do you have as it relates to, from an accounting perspective, numbers we should be tracking with the properties that are actually under contract or that we own, that we're working with our clients on?
Yeah, I mean, you mentioned one of my favorite things in the world, cost segregation.
Okay.
I think cost segregation is the eighth wonder of the world. If you own real estate, you need to look at that, right? It is an amazing tool to accelerate depreciation, right? And we can go into detail, and you know about as much about that as I do, but it's just something to really make sure you're looking at, right, and taking advantage of. I think cost segregation is a great tool. I always tell people it doesn't invent depreciation, right? It doesn't create, it accelerates it. It's a great tool to use there. What you're tracking, you got to look at everything there, from every expense, what's coming in, really looking at when you sign a lease. A big thing, you mentioned some of the improvements you make. What does it cost you in tenant improvements to sign a new tenant? Because most often tenants want what's called a TI allowance when they move into a building, right? It's like, well, I'm going to spend some of my own money, but how much are you going to give me as a landlord to build out my suite?
Yep.
What is that going to cost you, right? So that acquisition cost, I think, is huge to track. So you really know, what does it cost me to acquire new tenants? And so that's from the TI allowance that you have, like I said, to those leasing commissions that you're paying, and then to the ongoing management, expenses that you pay. So I think that's a huge one there. I think as you look at it, making sure that you're taking advantage of all your depreciation, back to the cost segments, tracking that as an accounting professional. I've talked to building owners. I've had very successful building owners come to me that own a portfolio and haven't done a cost segregation study, and look at, don't even really know, how depreciation is benefiting them right now on their building. It's like, let's get that right. This is one of the reasons why you own real estate. You mentioned, of comparables, looking, what is the market doing on cap rates? Typically you're gonna exit this building eventually, right? And when you do, what's going to be the cap rate you're going to be able to sell? What is that? How do you keep your building up? What are your maintenance and operations expenses that you really have to be tracking there, of how much are you spending every month, every week, every year on maintaining the building, right? Just to make sure it's profitable. And how do you get the most? Because a cap rate is typically your net operating income divided by your cap rate, right? Get your purchase price. So how do you maximize net operating income? And what things are you doing? Those relationships with your tenants, are they happy? Are they taken care of? And so I think those are a few of the things, right? Of just making sure that you know what's going on with that building, and that there's no surprise cost. I've done transactions before where, going through the leases, I've read items that can be billed back to tenants that never have. You've had this contractual right for 5 years and you've never billed this to a tenant. And what's difficult for the buyer coming in is like, I have a contractual right to do that, but how happy is that tenant going to be when they haven't paid this bill in 5 years and the new owner comes in and immediately charges them for it?
Yeah.
That's a battle, right? And that will affect the sales price too. When someone says, well, they're not going to pay this, they haven't paid it in a long time. So I think tracking those expenses of what do you have to pay as a landlord and what are your tenants responsible for is another major one to track there as well.
Now, you brought up a few things that I think are very important. One, tenant improvements. Obviously, there's something going on there with the investment in the property that the tenant may be doing and the things that you're doing as the owner. But as it related to cost segregation, one of the things that we want to consider there are good choices that can be made that can be accelerated, whether it be electrical, the lighting, maybe it's the flooring, perhaps it's landscaping. There are specific things that can be done that can be easily accelerated. Are there any insights that you have that the accounting professional should be aware of when they're considering advising their client as it relates to the commercial spaces they have?
Yeah, I think the biggest thing is the timing nature of it. So anytime you acquire or improve any part of your asset, you got to look at what you just spent. And is there need for an additional cost segregation study or just looking at it, of what you spent, because you can spend a lot of money on tenant improvements, right? You can spend a lot of money on building improvements of going through there. And so if you only look at that when you acquire the building, there could be hundreds of thousands of dollars you spend or millions of dollars you spend later on that you should also be looking at. Is there a way to accelerate that depreciation?
If you're looking to advance your career in accounting, you need to enroll now in the Job Placement Assistance Program. This course is created for accounting professionals to find a new job, apply for a promotion, or get a better position within a company. It is a turnkey process to actually help you better interview, get the job you deserve, and get paid what you're worth. For more information on how you can take advantage of this offer, go to the episode description. Enroll now in the Job Placement Assistance Program. Do it for free and act now. All right, let's look at HSI. Tell my listeners what that is and why it matters.
So HSI is a strategy we use. It's called historically significant items. And so it's a charitable giving strategy there that allows taxpayers to participate in the preservation and the donation of historically significant items out there. So it's a great way to preserve history and also save on taxes.
And so when you're looking at it, what is considered historical?
So for us, we have a number of original documents from significant businesses that operated hundreds of years ago. So we do a lot in the mining industry. And so we have documents from these old silver mines and other mining operations that we've been able to purchase and preserve, that universities and other not-for-profits have a huge interest in acquiring because they want to grow their library, grow what they have. And these documents are used by current students to see what happened, way back when. They're used by companies that are actually acquiring mining land around those. And they want to go in to see, well, what was done in the 1800s? What did they find? What did this look like? And it's part of our culture. It's part of our history. And some of these are actual surveys that they've done. Some of them are inventory reports, and some of them are memos, right? From me to you, Roger, like, hey, how's the day going, this and that. So it's really cool just to kind of see. But these collections are very significant, especially for universities to have. And it's a fun part, right? It's where we have a part in preserving this. Right. And also it can help save individuals on taxes that they pay at the end of the day. So this one, it's an individual strategy. Typically we say for income earners, if you're filing singly, right, we're probably, $300,000 and above. If you're married filing joint, probably about $450,000 and above there in your AGI, where you can really benefit from the strategy of helping to preserve these documents.
Interesting. So if you're not someone who has these documents, you're saying that there's a way that you can get involved in using the taxes to actually help with the HSIs, is what you're trying to say.
Yes. So people that come to us say, hey, everyone's wanting just to look at opportunities, right, to save on taxes.
Correct.
Here's something you can participate in. Here's a great program. We work with qualified universities. We work with world-renowned art historians, significant galleries. And these are, this HSI part of it, though, there's a lack of quantity, right? You can't just produce these, right? So there is a scarcity involved in acquiring these documents and using it, but it's really fun. Yes, it's great to save on taxes, and I support that. If you're doing it the right way, save on taxes like cost segregation, these things can help you. But when you get in and talk to these universities and see their excitement, I've been part of the donations, right, and met with the university staff and see their excitement when it's like a kid at Christmas, and they're getting these documents and they're excited. They're going through and analyzing this, and we make it very easy for them to use. We catalog it, we index it. It's not just a box of random documents, right? So they know exactly what they're getting, but they use it in their PhD studies. They use it in, as they write theses, and it's just so helpful to them. And they get excited about preserving history. They get excited about the knowledge that can be transferred to future generations about what actually happened back then.
Well, here's the thing that's disconnecting, though. I'm not hearing you explain exactly how the taxpayer is benefiting with the tax savings associated with this. So you're an accredited investor. You've got the $450,000 in income. That's who you are filing jointly. What does an HSI even matter? I don't have any historical documents. It's nothing I'm familiar with. I don't work with the schools or libraries. So how is this tax credit available to me as an accredited investor to where I actually have the opportunity to use this in my tax portfolio?
Yeah, no, great question. So basically, you're interested in saving taxes, right? And so you come to us and we're talking, here's an opportunity to help you save taxes.
It's a tax strategy.
Yep. So the way that we've worked with our art historians and our galleries, and we've come across, I would call it, a trove of documents, right? They're not infinite. It's a finite amount that they have there, but we've been able to index them, organize them, where you can come in as a taxpayer. You can purchase these documents, right? So they're yours.
So I buy the documents. They're now my documents.
They're your documents, right? Now, the way that we've purchased them and the way that we've taken care of them, you can buy them at, let's say $10,000, right?
Okay.
Now, what you do is you hold these for a certain amount of time, right? After you hold an item for over a year, you can donate that item at its fair market value. They have there for a charitable contribution.
So I'm going to purchase the documents. I'm going to store and archive the documents for a period of time. And then at some point, the following tax year, I'm going to donate them to probably a school, library, an art gallery. And in that donation, get the tax credit.
Get the tax credit for there. Now, what we do is we work with independent third-party appraisers, right? Because this is where you have to be sure someone that knows what they're doing appraises that item at its fair market value. Right now, we work, like I said, this is not something that we do. I'm not an appraiser. I'm not involved in the appraisal process whatsoever. We contract with third-party appraisers, and they appraise them to come up with a fair market value that you can use as part of your donation, right? When you do that, and you include that with your tax return. And because you held it for the year, right? And it's up to you when you want to donate it, but you can donate it at that fair market value. Now, the way that we've acquired these and using the experts that we've used, there's often I would say a price differential between what you paid for it and what that item's worth and what you can donate it for after you hold it for a year.
So you're saying it actually goes up, it appreciates.
It appreciates, and also, but it's worth a significant right now. It's not saying just in the year it's going to go up this much. So when you think of it, we've bought thousands of documents, right? Of a whole lot of these documents that are just in boxes. We found them in family members' garages that just didn't want to get rid of them, but didn't know what they were, or in a storage unit. And they really didn't know, it's like, I don't know, this was passed down for me. I have, 200 boxes of various documents here. They came from my family's business or whatever it may be. When we buy that lot and we go in and index them, we go in and organize them, we know how the universities want to see them, how they want to use them. We can create value there, and then we section it off where you're not buying the whole lot of documents, right? You're buying them in smaller amounts there. And so that price that you pay, is less than what they're actually worth. And because of the work that we do and how we purchase them, we can sell it to you for that amount.
Interesting. Let's talk about another one. There's renewable energy tax credits. I know that's something that a lot of people are a little bit more familiar with. So let's talk about how those can be actually used as a way of getting tax credits.
Yeah, so renewable energy tax credits are by no means new. They've been around. I think they started late 70s, right? Where they started talking about these options here, and they've changed, and they've added to, they've taken away. What the big change is now, and I think why they're back in the news, is for the first time, these tax credits are transferable, which means they can be bought and sold. In the past, to take advantage of a renewable energy tax credit, you had to be an equity owner in that project, right? And get the tax credits from it. So now you can come in as an unrelated third party, just looking to purchase tax credits to offset your tax liability. And obviously, if you're going to purchase tax credits, you're going to purchase them at a discount, right? So you know what taxes you owe. Your CPA, or you are the CPA. You've done your business. Hey, this is it. This is what you owe. Here's your tax liability. Well, you owe $1 million. You can write that check for $1 million, or you can buy tax credits at 90 cents on the dollar to pay that $1 million. So you can buy $1 million of tax credits for $900,000. Right, and saving you that 10% right there. And so I think that's the biggest thing, is these are now transferable. You don't have to be an equity owner in the project to benefit from these renewable energy tax credits that are available today. And that's what, on the B10 Energy side, that's what we do. We own projects ourselves. We work with builders, developers, out there as well. And we help, individuals and companies purchase these tax credits at a discount to offset their tax liability.
Interesting. So there's definitely going to be pros and cons to these. So give me some cons that might exist.
Cons, one, who are you dealing with? What's their experience in the field? Do you know them? Take a look at what is the underlying project where the credits are coming from. There's risk factors in this, right? There's recapture risk, right? Is that project going to be sold in the first 5 years? If so, those tax credits are recaptured at basically 20% per year. Have the credits been promised or sold to someone else? Right? So I think that it's the risk factors involved. Is it a valid project? Is it valid technology? Right. So it's really kind of doing the due diligence to mitigate those risk factors. And I say those would be the cons of just making sure you understand exactly who you're dealing with, what you're getting the information you need to verify those tax credits that you're looking to purchase.
As you're talking about this, I'm sure my listeners are just wondering, here we are, accounting professionals. Clearly, it's nice to be aware of these tax strategies and various things that we can take to our clients to help them. One of the things that I think is a question, though, is how much time as an accounting professional am I involved in such things as the HSI or perhaps the renewable energy tax credit? There's a lot of things that obviously I'm familiar with and comfortable with, but if I was to reach out to your company and have you assist me in servicing my client and helping them take advantage of these tax saving strategies, how much time is involved with the accounting professional as these are being done?
Yeah, that's a great question. And it really varies based on the professional of how much time he or she wants to be involved. We have some that have known us for a long time. They'll make an introduction to a client and say, hey, can you take it from here? Right? I trust you. I know what you're doing here. And I should probably state, yes, we're a collection of CPAs and attorneys and business professionals, but our firm exists to be an asset to CPA firms out there. We don't do any prep and file of any tax returns for clients. We're not looking to take clients. Our client is the CPA firm. We want to help you. And there are certain areas that we specialize in. And if one of the things that we do is helpful to you, great, give us a call. We're happy to work with you. We know these are your clients, and we're going to take care of them like your clients and make sure they get a great experience there. And so, some of them, especially early on, maybe want to spend some more time just understanding what we do, who we are, how the whole thing operates and works, and that's great. And some, like I said, they get the understanding of it. It's like, okay, hey, this sounds good. Can you keep me in the loop of what you're doing? But I don't need to be on every call, or I don't need to be in every meeting there. And so it really varies. I think most tax professionals want to do the initial due diligence and say, okay, who are these guys? Who are they? What do they do? Let me make sure I understand it. And we're happy to have those calls long before we ever talk to a client. Right? It just really working with a tax professional to get him or her comfortable with what we do and who we are. And then it's really up to them after that point. Like I said, we have some that we know the clients, we work with them, we go there and we keep the CPA up to date on everything. And some want to be involved in the process. So it really varies just based off their preference.
I appreciate that, because one of the things that I think is very important is as we offer accounting services, one of the things that naturally takes place with our clients is that question of tax planning. What can we do from an advisory standpoint to help them mitigate their tax liabilities? And they are open to and curious of what are those different things that I can do that might actually help me save in the tax liabilities that I owe. And these strategies oftentimes are either new to them, unaware, they don't know what they know. It's one of those you don't know what you don't know type of a thing. And so here we are wondering, as accounting professionals, what can we introduce them to? What can we maybe share with them, our strategies that they could consider and explore? And obviously someone like yourself is able to maybe further expound on what that strategy looks like, why it's something that they could take advantage of. And so I'm glad that today we were able to dive into at least a couple of these different strategies that someone may want to consider. Get your copy of Red to Black. It is the book written for accounting professionals to help businesses turn around and go from being in the red to being in the black. This book is written for consultants, business owners, operators, and managers. No matter what your client's product or service, or irrespective of your talent, skill, or expertise, as an accounting professional, you'll be able to use the principles presented in this book to actually become, for your clients, the profit and growth expert. Every chapter is filled with principles and concepts that you can use immediately with your clients to lead them from being in the red to being more profitable in their business, and see you as, in fact, their guide, their coach, with the expertise and wisdom that you can bring from this book. In the book, you have how-to guide explanations, you have models that you can follow, you're shown how to actually calculate and determine the fees for your services, the actual model that you'll use during the implementation of all this, and most importantly, the end-all results with your clients. Get this book now and see what it is you can do to offer this new revenue-producing service as, in fact, the profit and growth expert. For more information on how you can take advantage of this offer, go to the episode description and there get the information you need to take advantage of this today. So the next thing I'd like to just kind of clarify is, who is this strategy for? We were talking earlier about what an accredited investor might be, somebody that actually has a sizable income. Is it really just those clients that are, say, 300,000 in filing independent, 450,000 filing jointly? Is that really who benefits from these types of strategies?
On the HSI side, that's going to be the primary benefactors, right, of that strategy. And as we talk about that on the charitable donation side. When it comes to the RETCs, that's a little bit different, where because of the nature of these tax credits, they are passive by nature. So they're passive tax credits. And so the number one users of them right now are profitable C corporations. Right. So and those range, you got your big dogs out there doing it, right? And then down to smaller C corporations that are looking for ways to offset that tax liability. And so we usually say for users of that, it's going to be a C corp with at least about $500,000 of annual tax liability. To really take advantage. You can do a little bit less. What's great with these credits, there is a 3-year look back on these credits. So you can, 2025, you can look back to 24, 23, 22 and use it to get a refund of taxes that you've already paid. On the individual side, because they're passive, the ideal client would be an individual that has significant passive income, right? Or tax derived from passive activities, because that's the portion of your tax liability that you're going to be able to offset. And I should have brought this up, Roger, when you mentioned maybe the cons. That's maybe it would be a con. These are passive, and so it doesn't work for everyone, right? We want to make that very clear. C corps don't designate between active and passive income, right? So that's why they can use it. The individual side, it does take someone that has extensive passive income.
Very good.
We've worked with individuals, we work with C corps, but those are going to be your main benefactors there as you look at the RETC strategy or the renewable energy tax credit strategy.
So we've hit on 2 so far. What is another tax strategy that you find is very beneficial, and it's at an individual level? Let's talk about the personal level, because as accounting professionals, we're working with businesses. We do work with clients that are running companies, but oftentimes there's a question about them personally and how they can benefit from some tax strategies. What other ones would you suggest?
I think anyone that's looking at sizable capital gains, like I said, we'd love to talk with you because there's a couple different options you can do with capital gains. We'd love to have that consultation, right? Just kind of look at an individual like, hey, are you facing significant capital gains this year?
But give me some suggestions of what are some of the things that you might consider.
The way that it's set up, obviously going forward, there's some transactions that you can do after the gain. Obviously there's with setting up maybe some investments from other entities that we work with out there of creating a new entity. There's options that you can have in place where they're going to invest in your new company, right? And then how that new company operates. You can buy options there, and it's your choice as a business whether you let those options expire or what that may be. So there's ways that you can actually attract investment for new, or there's actually, if you don't want to do that, there's options to, you can create a capital loss in that instance. It's based on your business decision, what you want to do. But that was on our capital gains. It really is very personable to the individual. What do they want to accomplish, right? We've had some that have come to us and say, hey, I'm having this big event. I'm exiting from my company. I just want to go buy a couple boats, a house over here, a couple Ferraris, and be done. And on the consumption side, it's like, hey, that's great. If that's your goal, there's probably not a lot we can do to help out with that. On that side, if you just want to go out there, you've earned it, go. If you want to continue to build and invest in yourself and your business, those are some options we have to help you with that new business, actually attract future investment in it and set up a new entity for you.
So in addition to what you're suggesting, there are a few that I thought might come up for the fact that we were talking earlier about commercial real estate. A lot of times what happens is people are suggested to go get their commercial or their real estate license. And with their license that they can actually get a number of savings just because of the fact that they're now a realtor. The other thing that I thought might come up was the difference between an S Corp and an LLC and some of the investment or tax saving strategies that exist for the different entities, and how, if you've got, for example, investment properties, how you can structure from a tax strategy those different properties as independent individual type entities. Would you have anything to add to that?
No, I think you mentioned that the active real estate professional, a lot of things are open to you at that point in time. And I think as just with on the residential real estate side or commercial real estate side, if you're in real estate, you got to be looking at 1031 exchanges.
Yep.
For the individual there. I'm a big proponent of 1031 exchanges. If you haven't done one or you just heard about it, that's a great conversation. And the sooner you can plan for that, the better. I've dealt with a lot of individuals that have waited, have sold a property. I had a good friend come to me, just a quick story here of, hey, Eric, I sold an investment property. I heard about this thing called 1031. Can you help me with that? I'm like, sure, tell me about it. Like, I sold it last week. I'm like, well, where are your funds? They're in my bank account. I'm like, oh, did you hire a qualified intermediary? No, didn't do that. I'm like, well, that's part of a 1031 exchange, is to hire a qualified intermediary, right? So, and you know this, right? Where the funds stay, how long you have a certain amount of time to identify your property. You have a certain amount of time to close on your property, but you don't want to be making those decisions after the sale, right? Or when you come up on that, because I've had people that have purchased assets they probably wouldn't have normally purchased because they just were up against timelines and they didn't give themselves enough time.
So let's just real quickly explain the 1031 for my listeners so that they can understand what it is that's happening there with that transaction, because you're right, the transaction is happening and we want to take advantage of the 1031 before the transaction is done.
Correct. So your basic for a 1031 exchange, right? It's a way to defer your capital gains. It doesn't eliminate them. It's a deferral, right? So if I own, we'll just say something that maybe a lot of people can relate to. I own an investment property. I have a rental house. I've owned it for a few years. Let's say my basis in that is $100,000 and I sell it for $500,000, right? So I'm going to have a decent gain on that, right? I'm going to
$400,000.
Right, I'm going to owe some money, right? And if it's 20% of that $400,000, I'm going to owe $80,000 in taxes, right? That I have there. So what you do with a 1031 exchange is when you sell the property, you're going to reinvest what you got from that property into another property, right? So you don't actually take any money out at that point. So you sell it for $500,000. You take that, you pay off your loan, right? Whatever was associated with that. If you have a loan on that property, that money goes to a qualified intermediary. They take possession of it. So they have those funds. You then are looking for what's called replacement property. What do I want to invest? Now with 1031s, you do have to replace the debt that you had on the property. So let's say if I had a house that I had $250,000 of debt and I sold it for $500,000 and I go, great, I have $250,000. I'm going to go buy something for $250,000 and own it all cash. You can't do that. You have to replace that $250,000 of debt you had on the property. So your next property needs to be at least $500,000 or more to defer your gain. All right, so you can't pay off debt. If you do, that's boot. In this case, you owe taxes on that. But it's a great way to defer, and you continue to invest in real estate, right? So you can take on more debt if you want. So if you had a house, let's say $250,000, and it's like, well, I have $250,000. Maybe I want to buy $700,000 of real estate assets and take on a little more debt, if that makes sense, right? And grow my portfolio. So you continue that and you defer those taxes. You do not pay tax on that gain because you're not taking possession of it. You're rolling it into future investments. And so it's a great way for people that want to be in real estate and want to continue to invest in real estate, because if you sell the house, pay the tax, and then reinvest, you just cost yourself a lot of potential equity that you would have. And so I think 1031s are a great way out there to grow your portfolio, right? You defer those taxes. And I think it's also a tool for estate planning as well. We talk about once you pass on and your heirs and stepped up basis and what you can do in that. It's a great tool for, I would say, as your estate planning, it should always be part of it if you own real estate.
Yeah, basically the 1031s for the individual who wants to stay in the real estate market and doesn't want to capture those capital gains now. They want to actually just roll them into another property. And as you're saying, it's just a way that the government has created an incentive for you to stay in the real estate market because they're leaving those funds in that space. And so yeah, that's just a motivation for them. So here's what I'd like to do. I'm going to kind of wrap this up as it relates to our conversation because I thought this was a good discussion. But in doing so, just mention to my listeners that Eric's been very kind to actually offer his time. If you have questions about these concepts or would like to actually discuss maybe some application of them as it relates to tax strategies. So if you'd like a free consult with Eric and actually discuss a little bit further what it is that he would be suggesting as strategies for you or your clients, this is definitely something you'd want to take advantage of. So definitely take advantage of the episode description, the contact information there to reach out to Eric and speak with him specifically about this and some of the other strategies that we've discussed today. In addition to that, one of the things that I'd like to actually discuss is becoming a professional tax preparer. Here at Universal Accounting Center, we as a post-secondary school for accounting professionals train individuals both in individual and business returns. So if you'd like to more strategically go about pursuing a career in tax, become a professional tax preparer and get certified as such and carry after your name the PTP designation, showing that you're proficient both in the preparation and planning of individual and business returns. So with that, take advantage of the episode description, go there for more information about both. Also, what I'd like to do is as a summary of our conversation, and then I'll come back to Eric for a closing thought, is really point out that notice Eric began his career, interestingly enough, by being exposed to accounting in a fun, exciting way. The passion that was brought to him by that professor obviously had him change career paths or interests, and that was, I think, an amazing thing. He went from there, obviously, into Deloitte and became acquainted with commercial real estate and the different advantages that exist there. And I appreciate the fact that he was able to go into the specifics of that because we talked about just some of the strategies as it relates from an accounting perspective of helping our clients determine what is a great purchase when it comes to real estate. I thought that part of the conversation was very helpful just to know what it is that we should be looking for as we're assessing whether or not it's a good investment. And then after that, we got into a conversation about our clients, those who have properties, how do we actually help them from an accounting point of view maximize their investment? And that was one of the things that I thought that was very good because we got into then just different strategies that we can look at as it relates to future planning with that property, but also a discussion about cost segregation. There's definitely some cost savings there. And then obviously the different strategies that we went into, such as HSIs, and at the same time, the renewable energy tax credits, different strategies that we each can consider as we're working with certain types of investors. We also clarified that these are different strategies for high net worth individuals as well as corporations, just because of the passive income nature of the renewable tax or renewable energy tax credit. So these are things that have purpose and they have a place based on the current situation of the individual. And then we got into some conversation then at the end, obviously, about things as it relates to what it is we can be doing individually as we're looking at different strategies for ourselves, one being the 1031 exchange. So definitely some good tax topics today to consider as we're becoming the tax professionals that we need to be for our clients. So Eric, what else would you add to this discussion as a summary?
I think it's just, basically, hey, if there's people out there that can help you, as you mentioned with tax professionals, look for that. We understand there's no one individual that's an expert in everything, right? Look for those people to help grow your team, and we'd be honored, right, to be part of your team. That's why we're here. And there's other firms out there too that can be a great part of your team as you really look to see what can your clients benefit from. And I think the more that you can educate yourself on that and reach out to those experts, the better you're going to be, the better your clients are going to be taken care of, which really helps with retention of clients when they feel like, hey, I'm cared about. There's ideas being brought to me. There's other experienced professionals being brought in to look at my situation. And I think nothing makes a client feel more valued than when their tax professional brings in an expert and say, hey, I want you to talk with this person. I think there's some stuff here, or I've been thinking about your individual situation. And let's talk about a few of these things, right? And to do that, and I think that just helps us all. And so we're happy to be part of anyone's team if there's a service that we can provide. But I don't know. That's kind of maybe my parting comment there. Just, hey, reach out. There was a lot of people that I think as we work together can really provide great service for the clients out there.
Yeah, I appreciate that, because as we move beyond tax preparation services into tax advisory or planning strategies, it's great to have a team basically understanding that not everyone is an expert in everything. And there are different, let's say, strategies that meet the needs of certain individuals. And so it is kind of that fiduciary responsibility of what are we doing to take care of the client in their current situation and working with a team of experts to make sure we can do so effectively. So very well said in what you were describing there. So here's what I'm going to do to wrap this up. Obviously, as a podcast listener, if you haven't already subscribed, we'd like to invite you to subscribe to the podcast, get notified each and every week when we release new episodes as to various things you need to be considering as you're actually offering the premier accounting services in your area. It's also with that subscription that I want to invite you to go to universalaccounting.com, and there in the site navigation, find the podcast section, because it's there that we've collected a number of highlights. These are playlists that we've compiled of various topics that are specific to your situation. So there you can find podcast playlists as to marketing, selling, pricing, tech stacks, onboarding clients, mental health, client retention, just a variety of things that may assist your specific needs as they are today. So go binge listen those and find out what it is you can be doing to work on your business and, in fact, have the premier accounting firm in your area. In addition to all of this, I want to invite you to GrowCon. GrowCon is an annual conference, an event that you do not want to miss. It's for owners of bookkeeping, accounting, and tax businesses, where we actually bring to the stage experts to help us understand what we can be doing to work on our business. At the same time, we get to meet as peers, individuals who are like you, going out, starting, building, and successfully operating good accounting services. And in doing so, you get to build great relationships, have some collaborations to better service your clients, and build friendships. In addition, I also want to invite you to meet my staff. These are individuals here at Universal Accounting that are committed to your success, helping you be in business for yourself, but not by yourself with Universal Accounting. So take advantage of that and come join us for GrowCon. I look forward to seeing you there. Go to universalaccounting.com, and in the navigation, you'll see GrowCon. Click on that, get your ticket today, and I'll see you at the next GrowCon. Lastly, what I want to point out is if you'd like more information about this, how to become a professional bookkeeper, professional tax preparer, profit and growth expert, to better service your clients and get paid what you're worth, check us out at Universal Accounting School and find out more about these various services, courses, and programs that are designed to help you offer quality accounting services. In addition, you can give us a phone call. You can reach out and call us at 801-265-3777. And always remember this, accounting success is universal. Do take care, have a great day, and be safe out there.